Today I want to bring to you a live market update about mortgage rates. So the mortgage rates have been steadily increasing over the past month and a half or so, and and today we saw a big dip, a big drop in the mortgage rate. So I want to just talk about what is causing the interest rates on the mortgages to drop again, and if this is going to be something that is going to continue in the near future. So I think it's worth adding some background as to why the mortgage rates are dropping. By now, you know the Ukraine is at war with Russia. Our hearts go out to all of the Ukrainian people. Thoughts and prayers go out to them. Stay strong. But one of the something that this war is causing is the stock market, and the investors in the stock market want a safer investment, a less volatile investment than stocks and ETFs and so forth. So we're seeing a big shift in assets from stock portfolios into treasury bonds. Treasury bonds historically have been a safer investment for the consumer. So mortgage rates tend to follow the treasury bonds, more specifically the 10-year treasury bond. So as more investors flee the stock market, we see a little bit of a drop in stock and some of the stock prices, and more people buy bonds, the 10-year treasuries. Therefore, the yields of those bonds go down. And because the yields go down, mortgage rates tend to follow those yields, and mortgage rates have been dropping. So if you are in the market for a refinance or you are in the market for a purchase, I strongly advise that you lock in your interest rates immediately, right? Again, not financial advice, but just looking at the trend in the mortgage rates. This is one of those buy the dip opportunities, or lock the dip, like I like to say. So if you're in the market right now and you're ready to lock in your mortgage rate, strongly suggest that you do so. Call your mortgage broker, call your banker, and have them look at the different options for locking in your interest rates. It's important also to go back to one of the fundamentals of investing, that it says that time in the market always beats timing the market. So if we have individuals that have been sitting on the sideline because they think the mortgage rates were going up, they think that there's a market crash coming, et cetera, et cetera. These are the people that miss out on opportunities to invest and to build wealth over time. And if you are a person that was in the market to refinance and you didn't start the process, or you just you gave up on the mortgage interest rates and you're not ready to lock in your mortgage rate today, you missed out on a nice dip on the mortgage rates. So it's always, there's a lot of noise in the market, and there's a lot of volatility, and we're not sure what's going to happen, etc. Sure, but it's always important to stick to the fundamentals. Timing the market always beats time in the market always beats timing the market. It's extremely difficult for someone to try to time the top or the bottom of any market. That's why my investment strategy is always medium to long term. I'm not trying to time the dips in stocks or mortgage rates or anything like that. So with that being said, I want to show you what the 10-year chart or treasury bond is doing, so that you can kind of see my train of thought on this. So you can see at the beginning of 2000 of this year, the mortgage rates began to trickle up following the 10-year treasury. And there was a time where it went up and down. We have a little bit of a shoulder or a roller coaster adjustment and so forth, and then the rate just started going up. This was on news on the Federal Reserve going to increase not mortgage rates, but market rates in the middle of March. There's also confirmation from the Federal Reserve that they're going to end the taper. The taper, in short, is essentially the Federal Reserve is buying bonds to artificially keep the yields low, and therefore the mortgage rates low. It was a fail safe. It was a reaction to the COVID pandemic. And in my opinion, it was the right reaction at the beginning. To keep the mortgage rates low would essentially, minimize the risk of a complete real estate market collapse. Now, if you look at mortgage rates over the past 2 years, sure, the mortgage rates now are higher than they were in the past year to 2 years. However, if you zoom out in the time frame, you can see that the rates were essentially artificially kept low. And if we're going to compare the mortgage rates, mortgage market today to our history, we should not include the 2 year COVID pandemic, because the rates there were artificially lower. They were kept at a lowest possible so that the market would not crash. And if we look at where the rates are today, the 10-year Treasury bond, it's essentially still the lowest it's been in the past 5 years, with the exception, of course, of the 2 year of the COVID. Now we know that the Fed's it's going to stop buying these Treasury bonds in March. We know that the Feds are going to increase the short term, not the mortgage rates, the short term variable interest rates the middle of March. And we know that there's a shift from stocks and into treasury bonds, from stock investors looking for a safer place to keep their money as the war in Ukraine winds down, or it essentially comes to an end, hopefully sooner rather than later. But that is essentially what's causing these rates to come down. It's a shift of assets from your treasury bonds, from stocks and into the treasury bonds, which essentially will keep the yields down. So as long as people continue to shift, institutions, etc., continue to shift their assets from the stock portfolios and into treasury portfolios, we're going to see these mortgage rates stay down. So uh, going back to timing the market is incredibly difficult. If you were ready to lock in your interest rates today, you'd be able to lock in a phenomenal lock the dip opportunity today. Uh, with that being said, I really wanted to bring this to your attention today, because the rates have been trending up, and it's a very good opportunity to lock in your interest rate. So if you guys have any questions, or if you like more clarification as to why the rates are doing what they're doing, or if you want some estimates on your monthly payments, refinance options, and so forth, reach out to your mortgage banker, your mortgage broker. You could also reach out to us, and we'll be more than happy to answer any questions or concerns that you may have. So that's it on the rates and what the market is doing. Stay safe, everyone, and until next time, thank you.